Shares of Ford came down 18% after the company released their latest quarterly figures. Now, why did that happen? Is this an opportunity to buy cheap shares? That's what we're going to discuss in this video. So right now, this is what you're getting. One share of Ford will cost you $11.16. So a company with a market cap of $44.3 billion and a forward PE of just 5.8 times. Now, over the past 5 years, shares of Ford are up 33.12%. Year to date, the stock is now down 4.8% after being up closer to 25% just a week ago. Holders of Ford shares are also receiving a dividend. The dividend yield now is close to 7%. Now, if we're looking at what the analysts are expecting for the coming fiscal years, including this one, you can see year-over-year growth in revenue around 3% or so. EPS not growing this year, actually declining this year 2.4%, staying flat next year, and then in fiscal year 2026 expected to grow 4.26%. And now, before looking at some valuation metrics, if you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, would really appreciate that. If you want to support me even further, do check out the link down in the description and in the pinned comment with the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. So, if we currently look at Ford PE, EV to EBITDA, price to sales, price to free cash flow, and price earnings to growth, you can see here two sides of a story. Ford PE, 5.8 times, lower than its 5-year mean of 8.8 times. So you could say, yeah, I think it's quite cheap. EV to EBITDA, 11.4 times compared to 14.4 times. Price to sales, 0.3 times, which is basically around the same it has been previously. Price to free cash flow in the last 12 months, 8.4 times, also not that expensive at all, despite it being a little bit above the 5-year mean of 7.2 times. All of that is good. But if you look at what's expected to happen in the future, price earnings to growth sits at 12.7, and that's quite high. Now, the thing with Ford that despite paying a dividend, unlike GM, it is not really buying back shares. So returning capital to investors is not happening at the same level as GM, for example. Currently looking at the average analyst price target, that sits at $13.94, representing close to 25% upside from the price we're at today. There are 26 analysts covering Ford, but 14 of those have a hold rating. And so what exactly has happened this quarter? We've got revenue came in at $47.8 billion, that's up 6% year over year. But then when you look at the profitability of things, when you look at margins, all of those have come down. Adjusted free cash flow is up $0.3 billion year over year, so we're now at $3.2 billion. Here are the different segments, business segments for Ford, Ford Blue, Ford Model E, and Ford Pro. We're going to have a look at that in just a second. Now, inventory levels are at 94 days. Usually you want it to be around 50 to 60 days. So what you're going to see is probably more price reductions. And if that happens, if you reduce prices, well, we know margins will come down. Looking at a couple of extra things here, cash flow from operating activities under GAAP here is up $0.5 billion, so came in at $5.5 billion. Net income is down a little bit from $1.9 to $1.8 billion, with net income margin also dropping 0.4 percentage points. And this basically becomes the problem right now. They say here company net income was $1.8 billion and adjusted earnings before interest and taxes, or EBIT, was $2.8 billion. Profitability was affected by an increase in warranty reserves, though efforts to lift the quality of new products are starting to pay off. This has been actually an issue for Ford for a couple of years now. Repair costs have been extremely high. Continue by saying with positive implications for customer satisfaction and Ford's operating performance. So they say this is something that should not happen in the future. Let's see if that is true. Did say during the call, we did see warranty cost increase in the second quarter, of course, tied to new technologies, FSAs, and inflationary pressures for the cost of repair. We expect technology-related warranty costs to now normalize as technology matures and we deploy that great over-the-air capability to address known issues. We are confident we are on the right trajectory with a very clear and non-negotiable mission at Ford to deliver best-in-class quality. And this is the thing. Although I do think that Ford will succeed in the future, this is a problem for a lot of legacy players. Because as you now build more, let's call them computer on wheels, you will run into those types of issues early on. You will have to recruit great engineers, software engineers, stuff like that, things that you did not recruit previously. You will have to build departments in your company that deal with these types of things. You will have to build specific systems that deal with these types of things as well. You do not want to be late to the party when it comes to the computer on wheels generation, right? Cars that basically have lots of technology parts in it, software updates that can usually fix most of the issues, as we've seen with companies like Tesla. Now, for companies like Ford, like GM, still, let's say, early days when it comes to EV build outs or even their legacy cars, right? Because the legacy cars are also becoming smarter and smarter. And so if you're not dealing with those issues early on, then yes, you are going to get hit with repair costs each and every year. And the goal for the company is to catch those mistakes before the customer actually notices it. Let's see if they can figure it out. Now, continuing here, let's start with the Ford EV segment, so Ford Model E. Volume down 23%, revenue down 37%, EBIT loss flat at $1.1 billion. So they're already making a little bit here of improvements. So they say here, negative points, market factors, material costs becoming a bit better, battery economics becoming better, and engineering expense becoming better as well. But overall, Model E, I mean, if you can look at the first half here, EBIT margin here of negative 194.8% with a loss of $2.5 billion. That can grow to $5 billion, can be a bit more, can be a bit less. So that dragged down the business. On the flip side, you've got Ford Pro and Ford Blue that are doing a bit better. So they're helping the business right now. For Ford Pro, volume and revenue up 3% and 9% respectively, EBIT margin of 15.1%. If you look at Ford Blue, volume and revenue up 3 and 7% respectively. Why is that? Well, as we've said, the warranty issue, new product material costs, manufacturing costs as well. Some positives in market factors. They're profitable in all regions. So the majority, let's say, of the hit for Ford is coming from the EV segment, and then the warranty issues. You've got some positive coming from Ford Blue for volume and revenue, but definitely more positive sides coming from Ford Pro. And so if we look at the guidance, that includes flat to modest US industry growth at 16 to 16.5 million, full year of all new Super Duty drives positive pricing and mix in Ford Pro, lower industry pricing, so that should be a negative effect on the business, and a $2 billion cost reduction in materials, freight, and manufacturing. They did increase the total company adjusted free cash flow outlook. Prior outlook was between $6.5 and $7.5 billion. That now sits between $7.5 and $8.5 billion. So that's definitely a positive. And so looking at the stock right now, of course, a big red candle for the week. We're now back to levels not seen since early January of 2024. That was previously a bottom. Could be a good choice to buy right now. I mean, the company does look cheap, but there still is a lot of work to be done. Yes, you're getting a nice little dividend payout. Yes, it's true that from a valuation standpoint, some of these metrics look quite cheap. Ford, still, I believe, the number one for ICE, number two for EVs in the United States. I don't think they will go down or they will go anywhere or disappear in the next coming years. So this might be a bet on their success in the future. But in the near term, in my opinion, there still is quite some issues at the company, because I do think that pricing is going to be an issue. I do think that dealerships still need to reduce their inventory. And so if you're pricing your vehicles, which by the way, the price of the vehicles have gone up throughout the last couple of years, inflation, of course, which of course means that when the revenue is up, that doesn't necessarily mean that, oh, suddenly revenue is up, you're selling way more vehicles. No, the price of the vehicles has increased. Inventory is up, meaning cars that go to the dealerships get stuck at the dealership, might never reach the hands of future customers. That's a problem. How do you solve that problem? Well, you solve that problem by reducing the price to make it more affordable. But if you make it more affordable, your profitability margin gets hit. Unless, of course, you work on that side of the business, cost of goods sold comes down, etc., etc. I don't think this happens overnight. No, it takes time. I do think that under Farley's leadership, Ford will succeed, but it will take some time. That said, I think that at current prices, if you're a Ford shareholder, yes, I do think it's worth buying back more shares, because being down 18% just because they took such a big hit for the warranty issue, it's something that they will definitely solve. How fast? I don't know, but down 18%, quite an overreaction in my opinion. It's just my opinion, of course. Do share yours down in the comment section below. If you enjoyed this type of videos, give it a thumbs up, subscribe if you have not, and I'll see you all in the next one. Bye bye.